If you look at last week's close, the S&P 500 just secured its 10th winning week out of the last 11. I mean, on the surface, the tape is just bathed in green.
Right, it looks completely unstoppable.
Exactly. It looks like a picture of absolute dominance. So why are professional traders terrified, hoarding cash, and, heavily shorting the index heading into tomorrow?
Well, because we are looking at a market that's completely decoupled from reality right now.
Yeah.
The surface metrics tell this story of a euphoric bull run, but if you look under the hood at the underlying plumbing, the institutional flow, the volume, you find extreme structural fragility.
Which is wild to see. So, for context, it is Sunday morning, June 14th, 2026. The screens are dark, the markets are closed, but tomorrow morning kicks off what is undoubtedly one of the most critical macroeconomic weeks of the quarter.
Absolutely.
Our mission for today's deep dive is to cut through all this weekend noise and really unpack this massive macro tug-of-war. We have an incredible stack of sources today. We're talking institutional strategy briefs, technical damage reports, and a severely high-impact macro calendar.
And we're going to look at how a historic tech IPO, shifting geopolitical tectonic plates, and a massive changing of the guard at the Federal Reserve are all colliding.
Yeah, creating what Wall Street calls a pain trade trap for active investors. So, okay, let's unpack this. Because to understand the momentum carrying us into tomorrow morning, we have to dissect the incredibly unusual mechanics of what just happened on Friday.
Right. And Friday's price action is a perfect example of that surface-level illusion. The S&P 500 closed at 7,431.46.
Up about 0.5% on Friday.
Exactly. And the Nasdaq 100 closed up 2.34% for the week at 29,635.95. A casual observer looks at that weekly time frame, sees those structural trend lines holding, and assumes broad organic economic growth is driving the bus.
But it wasn't organic at all.
No, the action was hijacked by two very specific, massive catalysts.
Sure. Let's start with the geopolitical one. So, Brent crude oil took a serious dive on Friday, tumbling 3.4% down to $87.33 a barrel. And this wasn't some random inventory fluctuation.
No, the markets are pricing in reports of a historic U.S.-Iran Memorandum of Understanding.
Right, which might actually be signed today in Switzerland, aiming to reopen the Strait of Hormuz.
And that potential deal acts as this massive deflationary sigh of relief, because energy costs are the baseline for almost everything in the global economy.
Yeah, it cascades into everything.
Exactly. When oil drops that aggressively, it instantly cools inflation expectations, which takes pressure off the bond market.
Because investors aren't demanding as high a yield to compensate for future inflation.
You nailed it.
But the flip side of that macro relief was the absolute frenzy over in the tech sector. I mean, Elon Musk's SpaceX, trading under SPCX, finally had its historic Wall Street debut.
And what a debut.
A $1.77 trillion IPO. The stock soared 19.2% from its $135 IPO price to close at $161.11. And the strategy briefs point out a phenomenon here called the liquidity zap.
Yeah, which is a great term.
I was thinking about this, and it's like a new must-have blockbuster video game console dropping. Everyone is instantly emptying their wallets for SpaceX, which means they have to sell off their older toys, their other mega-cap tech stocks, just to free up the cash to buy it.
What's fascinating here is that the volume profile on that liquidity zap tells the real story. Desk flows show active managers aggressively liquidating secondary tech names just to make room for SpaceX.
Wow.
But if you zoom out to the broader market volume, the late-week recovery actually happened on declining volume.
Right.
We dropped from 5.6 billion shares, traded down to 4.9 billion by the end of the week.
Wait, so the price of the index is going up, but fewer and fewer people are actually participating in the move?
Exactly. The big money wasn't stepping in to buy the broader market.
Right.
Institutions are preserving cash. What pushed the market higher was a combo of SpaceX hype, the Swiss peace deal headlines triggering a short covering relief rally, and dealer delta hedging near the 7,429 gamma flip level.
Okay, hold on. Let me stop you there. You can't just drop dealer delta hedging near a gamma flip level and keep going. Walk me through the actual mechanics of that.
Sure.
What exactly is a gamma flip?
Think of options market makers. The dealers, like sports bookies, they don't want to bet on the game, right? They just want to collect the fees for taking your bet.
Right, they want to stay neutral.
Exactly. So if a ton of retail traders are suddenly buying call options, betting the market will go up, the dealer has to take the other side of that trade. To ensure they don't lose money, if the market actually does go up, the dealer goes out and buys the underlying stock to hedge their risk.
So they're buying the stock not because they think it's a good investment, but just to balance their own ledger.
That is the crucial distinction. And a gamma flip level is the mathematical tipping point, where dealers go from selling stock as it rises to being forced to buy stock as it rises to keep their books neutral. Yeah, so right around that 7,429 level on the S&P, dealers were forced to blindly buy the index as it moved higher. It's mechanical algorithmic buying. It has zero to do with fundamental economic health.
Which perfectly explains the massive disconnect we're seeing in the sentiment data right now. Because if the market just had its 10th winning week, you'd assume sentiment is just absolute euphoria.
You would think so.
But when you move from the surface price action to the sentiment surveys, it's like looking at two completely different planets.
The divergence is staggering. The AAII bearish sentiment spiked to 47.7%. That is the highest level of fear since April. Meanwhile, bullish sentiment plunged down to 30.4%.
And the CNN Fear and Greed Index is sitting at 29.7, which is officially in the fear zone. Keep in mind, back in May, that index was sitting at a peak greed level of 71.
It's a massive vibe shift. Add to that the futures market. Speculators are holding a massive net negative 205.6K short contracts in S&P 500 futures.
That is a lot of people betting heavily on a crash. But I have to challenge this setup, though.
Yeah.
I mean, if the index just rebounded and held its structural trend line above the 50-day moving average, why are traders bracing for a crash? Are they just acting irrationally at this point?
Well, no, we have to remember the psychological trauma the market endured recently. The market suffered a sharp 4.5% pullback from its June 2 all-time highs of 7,600.
Right, I remember that.
And that drop was triggered by a hot May payrolls report. We added 172,000 jobs, which spiked yields and triggered a rapid sell-off.
Yeah.
That completely flushed out all the weak hands and ended up resetting the deck entirely.
So active traders got burned, they panicked, and now they're either sitting in cash or they are heavily short, waiting for the other shoe to drop.
Exactly. And that positioning introduces one of the most dangerous dynamics in trading, which is the pain trade. Because positioning is violently skewed to the short side, the market becomes a coiled spring. When you have 205.6K net short contracts, any good news forces a mechanical short squeeze. Historically, when bullishness is this low, the S&P 500 averages a positive 10.7% return over the next 12 months.
Right, because of the mechanics of a short squeeze. If you're short, you've borrowed shares and sold them, hoping to buy them back lower. But if the market rises, your broker issues a margin call, and you're forced to buy the index at the current high price just to cover your position.
And your forced buying pushes the price even higher.
Which forces the next short seller to cover. It's a cascading loop. So the pain trade is violently to the upside. And the match that could ignite that tinderbox is scheduled for this coming Wednesday.
Yes, Wednesday, June 17 at 2:00 p.m. Eastern, the FOMC interest rate decision.
The consensus expects a hold of the current 3.50% to 3.75% range.
But the real story hits at 2:00 p.m., the inaugural press conference of the newly sworn-in Fed Chair, Kevin Warsh.
This is huge. He's stepping into an incredibly complex policy vice. Because on one hand, Warsh was appointed by President Trump to cut rates. But on the other hand, May's CPI is currently running hot at a 3-year high of 4.2%.
It's an impossible situation.
So what does this all mean for the markets? The institutional briefs show Wall Street is laser-focused on whether Warsh will formally drop the Fed's easing bias or scrap the famous dot plot entirely.
Right, and if we connect this to the bigger picture, Wednesday presents a massive binary risk. Scenario 1 is the hawkish pivot. If Warsh signals that hikes might be back on the table for late 2026 because of that 4.2% CPI.
Mega cap tech sells off violently.
And the U.S. 10-year yield, which is currently at 4.48%, breaks its critical 4.55% pivot level, that would crush risk assets.
But what if he's dovish? If he acknowledges the inflation but maintains a flexible pause?
Then we see a massive relief rally in crypto, small caps, and equities. The shorts are forced to cover en masse.
Okay, here's where it gets really interesting. Let's move from central banking theory down to your actual game plan. How does this play out in your wallet when the bell rings tomorrow morning?
Well, the Fed isn't the only red folder event this week. Wednesday morning at 8:30 a.m. Eastern, we get U.S. May retail sales.
With a consensus of plus 0.5%.
Right. And the sector squarely in the crosshairs there is real estate, ticker XLRE.
Because 30-year fixed mortgage rates recently surged back to 6.62%.
Exactly. If retail sales come in hot, the 10-year yield breaks higher, and mortgage rates push closer to 7%, crushing XLRE.
And the secondary sector to watch is consumer discretionary, ticker XLY. They are caught in a lose-lose valuation loop right now. If retail sales miss, it shows a weakening consumer, destroying profit margins. But if they beat, Bond yields rise, raising their cost of borrowing.
It's precarious. And for the broader market, you have to respect the key pivot levels. For the S&P 500, the line in the sand is 7,265. For the NASDAQ 100, the pivot is 28,500.
Plus, time horizon management is critical. We have Super Thursday bringing SMB and Bank of England REIT decisions.
And then U.S. markets are completely closed on Friday for Juneteenth.
Right, so that guarantees high volatility Thursday afternoon as desks square up ahead of the long weekend. So the strategy from the sources is clear. Keep your core positions, don't chase breakouts early in the week, and keep some dry powder ready for Fed week volatility.
You want cash available to deploy when the volatility inevitably creates myth-priced opportunities.
Exactly. So just to recap, we are heading into a week where extreme bearish positioning meets a new Fed regime and a potential geopolitical reset.
It's the perfect storm. And there's one provocative thought from the sources I want to leave everyone with.
Right, yeah.
We mentioned rumors that Kevin Warsh might roll back forward guidance mechanisms like the dot plot to reduce market handholding.
Right.
If the Fed stops telegraphing its every move years in advance, are we entering a new era where Wall Street actually has to fly blind, relying purely on real-time data instead of central bank safety nets?
That is a phenomenal question for everyone to mull over. They take the GPS away, the market has to learn to navigate in the dark. Thank you for joining us for this deep dive. You have the levels, you understand the mechanics, and you know where the traps are set. You are armed and ready for tomorrow morning. We'll see you at the opening bell.